Today, I want to talk to you about something that could change your life forever. I want to discuss the top 10 mistakes that you're making with your money. These are the mistakes that most people don't know about, but they're the ones that could be holding you back from achieving your dreams. Mistake 1. Failing to track your expenses. Think about it. How can you expect to reach your financial goals if you don't even know where your money is going? Tracking your expenses is crucial for financial success. It allows you to see exactly where your money is going and make adjustments as needed. It's like having a roadmap to your financial future. But don't worry, tracking your expenses doesn't have to be a tedious task. There are so many tools and apps available now that make it easy and even fun to keep track of your spending. From budgeting apps that categorize your expenses for you to good old-fashioned pen and paper, there's a method that will work for you. Mistake 2. Overlooking hidden fees. Hidden fees can come in many forms, from ATM fees to subscription fees that automatically renew without your knowledge. They're sneaky and can catch even the most financially savvy person off guard. But don't let that discourage you from taking action. By being proactive and doing your research, you can avoid many of these hidden fees and save yourself a lot of money in the long run. One great way to avoid hidden fees is to read the fine print carefully. Before signing up for any service or purchasing a product, make sure you understand all the associated fees and charges. It's also a good idea to regularly review your bank and credit card statements to check for any unexpected fees. Mistake 3. Not prioritizing debt repayment. When you have debt, it's essential to make it a priority to pay it off as soon as possible. Every day that you carry debt, you're paying interest and fees, which can add up quickly. By making debt repayment a priority, you can save yourself a significant amount of money in the long run. But repaying debt isn't just about the financial benefits. It's also about the peace of mind that comes with being debt-free. When you're constantly worrying about your debt, it can take a toll on your mental health and overall well-being. By taking action and making a plan to repay your debt, you can alleviate that stress and feel a sense of accomplishment as you see your balance decrease over time. So, how do you prioritize debt repayment? One popular method is the debt snowball method, where you focus on paying off your smallest debts first and then work your way up to your larger debt. Another method is the debt avalanche method, where you focus on paying off the debt with the highest interest rate first. Mistake 4. Not having the right insurance coverage. We'll get to that in a second. I have a favor to ask of you. If you like this video so far, please subscribe to the channel. Having the right insurance coverage is essential to protect yourself and your assets. Whether it's home insurance, car insurance, or health insurance, you need to make sure you have the appropriate coverage for your needs. Otherwise, you could end up paying out of pocket for expenses that should be covered by your insurance. But insurance can be complicated, and it's not always easy to know what coverage you need. That's why it's essential to do your research and seek professional advice if necessary. Don't just choose the cheapest policy or the one with the most attractive advertising. Make sure you understand what's covered and what's not, and don't be afraid to ask questions. The consequences of not having the right insurance coverage can be severe. Imagine getting into a car accident and finding out that your insurance doesn't cover the damages. Or experiencing a natural disaster and realizing too late that your home insurance doesn't cover the type of damage you suffered. These situations can be devastating, both financially and emotionally. Mistake 5. Misunderstanding investment fees. It's essential to understand the fees associated with your investments and how they impact your returns. Some fees, such as management fees and expense ratios, are necessary to cover the costs of managing your investments. However, others, such as front-end loads and back-end loads, can eat away at your returns without providing any added value. The problem is that many people don't take the time to understand these fees or read the fine print before investing their money. They assume that all investments are created equal and that the fees charged are reasonable. Unfortunately, this is not always the case. Misunderstanding investment fees can have serious consequences for your financial future. It can mean the difference between reaching your financial goals or falling short. Even a seemingly small difference in fees can add up to significant amounts over time, potentially costing you thousands of dollars in the long run. That's why it's crucial to take the time to research your investment options and understand the fees associated with each. Don't just look at the potential returns, but also consider the fees and expenses involved. By doing so, you can make informed decisions and ensure that you're getting the most out of your investments. Mistake 6. Falling for financial scams. The sad truth is that scammers are becoming more sophisticated and creative in their tactics. They know how to manipulate people's emotions and convince them to part with their money. They often use fear tactics, promising quick and easy money or pretending to be a reputable company or organization to gain your trust. One of the most common financial scams is the Ponzi scheme, where investors are promised high returns on their investment, but in reality, the returns are paid out of new investors' money. This cycle continues until the scheme collapses, leaving investors with nothing. Other scams include fake investment opportunities, fraudulent charity requests, and fake bank or credit card companies. These scams can be difficult to detect, and it's essential to be vigilant and do your due diligence before parting with any money. The consequences of falling for financial scams can be severe, leaving you with significant financial losses and potentially ruining your credit score. In some cases, it can even lead to identity theft, where scammers use your personal information to open accounts or make purchases in your name. To avoid falling for financial scams, it's important to be skeptical and cautious. Don't believe everything you see or hear, and never give out personal or financial information over the phone or email. Research any investment opportunities thoroughly and only invest with reputable companies or financial advisors. Mistake 7. Not taking advantage of tax deductions. Tax deductions are expenses that you can subtract from your taxable income, reducing the amount of taxes you owe. There are many deductions available, from medical expenses to charitable donations, and even job-related expenses. However, many people don't take the time to research and claim these deductions, leaving money on the table. One of the most significant tax deductions available is for home mortgage interest. If you own a home and have a mortgage, you can deduct the interest paid on your mortgage from your taxable income. This deduction can result in significant tax savings. Another commonly overlooked deduction is for job-related expenses, such as uniforms or work-related travel expenses. If you have unreimbursed job-related expenses, you may be able to deduct them on your taxes. Charitable donations are another area where people often miss out on deductions. If you make donations to charity throughout the year, be sure to keep track of them and claim them on your taxes. This can not only help you save money, but also benefit the organizations you support. Mistake 8. Not planning for healthcare costs in retirement. The reality is that healthcare costs can be substantial in retirement, and they tend to increase as we age. Without proper planning, healthcare expenses can quickly deplete your retirement savings, leaving you financially vulnerable. One of the biggest mistakes people make is assuming that Medicare will cover all their healthcare needs. While Medicare is a valuable resource, it doesn't cover everything, and out-of-pocket expenses can add up quickly. Long-term care is another area where people often fail to plan. The cost of long-term care can be astronomical, and Medicare only covers a limited amount. Without proper planning, long-term care expenses can quickly wipe out your retirement savings. Another mistake people make is underestimating the cost of prescription drugs. As we age, we tend to require more medications, and these can be very costly. Without proper planning, the cost of prescription drugs can become a significant burden in retirement. Mistake 9. Ignoring the impact of inflation. Inflation is the gradual increase in the price of goods and services over time. This means that the same amount of money you have today will buy less in the future. For example, $1 today will not have the same buying power as $1 10 years from now. Ignoring the impact of inflation can be particularly damaging for retirement planning. Many people assume that they can live comfortably in retirement with a fixed income, but they fail to consider the impact of inflation on their purchasing power. This mistake can lead to a situation where retirees find that their income is no longer sufficient to cover their expenses. This can be especially problematic if they have not planned for the possibility of increased healthcare costs, which tend to increase faster than the rate of inflation. So, what can you do to avoid this mistake? One strategy is to invest in assets that can provide a hedge against inflation, such as stocks, real estate, or commodities. Another strategy is to adjust your retirement plan to account for the impact of inflation on your expenses. Mistake 10. Neglecting to diversify investments. Diversification is one of the most important principles of investing. It means spreading your money across different types of assets, such as stocks, bonds, and real estate. By doing this, you reduce the risk of losing all your money if one investment performs poorly. But many people make the mistake of putting all their money into one type of investment, often because they think it will provide a quick return or because they don't know how to diversify properly. This can lead to disastrous consequences if the investment takes a turn for the worse. One example of this is the dot-com bubble of the early 2000s. Many investors poured all their money into tech stocks, thinking they were guaranteed to make a profit. When the bubble burst, however, many lost everything. Another example is the 2008 financial crisis, where people who had invested heavily in real estate lost everything when the housing market collapsed. Diversification is not a foolproof strategy, but it is an important tool for managing risk in your investment portfolio. By spreading your money across different assets, you can reduce the risk of losing everything if one investment doesn't work out. It's important to remember that financial mistakes can have a lasting impact on your life, and it's never too late to make a change.